Good. How are you? No matter. Answer him. All right, we're module 3, analyzing and reporting business transactions. Excellent. Okay, today's lecture then is on how we analyze business transactions. Now, a transaction is an exchange. You work for a company, you exchange your time for money. You walk into a store, you buy an item, and you exchange money for that item. So you see a transaction, two things are happening. There's an exchange. All right? And that's what we're going to analyze now, business transactions. So you can imagine in a small business, there could be hundreds of transactions in one day. And the accounting system is designed to record every one of those transactions. So what we're talking about is a system that collects data, transactions, processes transaction data, and communicates them to people who are making any kind of decisions about it. Now, as I said, a transaction are economic events that require that we record that event in the accounting records. Now, not all events are transactions. Not all activities are transactions. However, a transaction will affect either the assets, liabilities, or the shareholders' equity of a company. And it will affect those records, those assets or liabilities or shareholders in two places. So it's a dual effect, all right, on the accounting equation. Keep in mind the accounting equation is assets equal liabilities less shareholders' equity or owner's equity. For example here, the event is I purchase a computer. Is that a transaction? Does that affect the assets, liabilities, or shareholders' equity of the company? Yes or no?
Yes.
Yes. Good. That means, of course it does. There we go. Purchase of a computer is a transaction because I've got a computer and I had to give up cash or a promise to pay it. I discussed a guided trip with a potential customer. Is that a transaction? I am a travel agent and you come in and you want to book a trip. Is that a transaction? Has there been an exchange here of assets, liabilities, equity? I see you shaking your head, so I gather you say no. You're right. That is not a transaction. It does not affect the assets, liabilities, and equity of the company. The company pays rent. Is that a transaction? Yes. You see it. Okay. So I record the purchase of a computer. I do not record the discussion regarding the trip, but I do record the payment of rent. These are transactions. They affect the accounts of the business. Now, when I talk about the accounts of the business, there are asset accounts, liability accounts, and equity accounts. Now, when I analyze the business transactions, I do that in relationship to the basic accounting equation. Think of the balance sheet. Assets equal liabilities plus shareholders' equity. Recall, assets are the resources that the company owns. Liability are debts that the company owes to other businesses or entities. And shareholders' equity is the investment the shareholders have put in plus the retained earnings. You recall with your financial statement analysis. A transaction now affects assets and or liabilities and or shareholders' equity. It affects two of them. Now, to demonstrate this, we're going to expand that accounting equation. Assets equal liability, but the shareholders' equity, you see, is two parts. Common stock, which the shareholders have purchased from the company, plus retained earnings. Now, that's the earnings the company has retained, kept. Has earned and kept it, have not given it back in the form of dividends. But when I look at retained earnings, you see, it goes up every time the company earns revenue. It goes down every time the company pays an expense, and retained earnings goes down when the company pays the shareholders dividends. Okay? So therefore, that's the 5 categories of accounts that we want to analyze. Assets, liabilities, revenue, expenses, and dividends. Now keep in mind, a business transaction will affect 2 of these. So let's look at some business transactions. And what we're going to do now is we're going to expand the assets. We're going to name them. The assets this company owns are cash, supplies, prepaid insurance. Remember, you prepay your insurance for a year, plus equipment. Who the company owes? They have notes payable, they have accounts payable, and they have this thing called unearned service revenue, which will be explained later. Now, the shareholders' equity section, we have common stock, but instead of retained earnings, we're only going to deal with revenue, expenses, and dividends. Okay? Now, let me ask you this. On October 1st, cash of $10,000 is invested in Sierra Corporation, and we're doing the records for Sierra Corporation, by investors in exchange for $10,000 of common stock. Question, is that a transaction? Yes. Pardon? Is that a transaction? Yes. Yes, that is a transaction. That means I must record it in my records. If it's a transaction, it has affected 2 accounts. Now look at the transaction. What accounts were affected? Cash is one. And what? Pardon? Common stock. Very good. Okay. Did cash go up or down? Pardon? Down? Up. Up or down? Up. Yeah, the company has more cash. Did common stock go up or down? Down. They have a negative common stock. Did common stock go up or down? Up. Okay. Right. So if I was to record that, transaction one, I record a $10,000 increase in cash. You understand that? And a $10,000 increase in common stock. Is that correct? Yeah. Am I in balance? Does this equation balance? Why? Why do you say it's balanced?
Both sides are equal. The assets and liabilities.
There's an increase on the asset side. And there's an increase on the shareholders' equity side. So that's in balance. And that will be the essence of every transaction. If you record it properly, the transaction will always be in balance. That is, this equation, assets equal liability plus shareholders' equity, will always be balanced. And it is balanced. On October 1st, Sierra borrowed $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. Which two, is this a transaction?
Yes.
Yes. If it is, then it affected two accounts. Which two accounts? Cash and notes payable. Cash go up or down? Yeah, I got money, right? Notes payable go up or down? Down?
You got more notes payable.
I've got more notes payable. You're right. I have no notes payable now. I have more. Am I in balance?
Yes. Yes.
Is it equal on one side and the other?
Yes.
As long as it's equal on both sides of that equal sign, I'm in balance. That's right. Now, on the next transaction, I purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. Transaction? Yes. Which two accounts?
Equipment and
Pardon?
cash. Equipment and cash.
Equipment and cash. Did cash go up or down?
Down.
Down. Did equipment go up or down?
Up.
Right. Am I in balance? Yes, a negative and a positive, both on the same side of the equal sign, means that I'm in balance. Any questions? You see what we're doing? We're recording business transactions. And those are exchanges where two accounts are affected. And the other thing is, it always remains in balance. Now, this one is a little different. When I provide a service to a client, when I provide that service, I earn revenue. And the client either pays me or the client owes me. You understand that? But if the client pays me in advance, I've got the money, but I have not provided the service. So you see, I have a liability to provide that service. And we call that liability unearned service revenue. Unearned service revenue. And so you see, I have the cash, so my cash increases. However, I have a liability, so my liabilities increase. And that always is unearned revenue. When a customer pays me in advance. Okay? Now, you want to fly to whatever country, you pay the airline in advance. They haven't earned it because they haven't flown you there. They have an unearned liability. Now, make sure you understand these because they will begin to repeat themselves and they always follow the same thing. If it's a transaction, it will affect these accounts in two different areas, and it will affect it in such a way that the accounting equation is always in balance. So now on the third, I received 10,000 in cash for guide services I perform. Well, obviously that's a transaction. I performed a service and I received the money. Which two accounts? Cash? Very good. Revenue. Revenue go up or down?
Up.
Revenue never goes down. Always goes up. And if I get cash, cash goes up. And I did. I get cash and revenue. Okay. On the third, Sierra paid its office rent for the month. Which two accounts?
Cash and bank.
Right. Now rent. What kind of account is rent? It's an expense. Do expenses go up or down?
No.
Your expenses go down?
No, it's just goes up.
Expenses always go up, just like revenue. Always, but notice it's got a negative sign in front of it. So therefore, I record it as a negative. So I have a negative on the asset side, and I have a negative in the expenses. Any questions? All right. On October, Sierra paid 600 for a 1-year insurance policy that will expire next year, September 30th. Right, prepaid insurance. So what's the other account? Cash. Cash goes down, prepaid insurance goes up. Both on the same side as the equal sign. Any questions? Okay. October 5th, Sierra purchased supplies on account from Aero Supply for $2,500. What is that? Purchase office supplies for $2,500. Which two accounts? Cash and supplies. And on account, sorry, not cash, accounts payable. Purchase supplies on account. So they didn't pay cash. They have an account with Aero Supply. And because they purchased, they owe Aero, so their liabilities go up by $2,500. And supplies go up. Now, on the 10th, I paid a dividend. And cash. So,
Yeah, it goes up, dividend goes up.
right, -500, -5. Questions? On the 11th, I paid the employees. Which two accounts?
Cash and salaries.
And what?
Salary.
Salaries expense or wages expense, yeah. Negative and negative. You see how we're always in balance. Now, when I totaled them up, these are the effect all the transactions have on the account cash. At the end of October, I now have cash of $15,200. I have supplies of $2,500. I have prepaid insurance of $600. I have equipment of $5,000. So I total my assets. Those are resources I have. I have $23,300 on assets. On the other side, I have liabilities of $5,000, notes payable, $2,500 accounts payable, and $1,200 unearned service revenue. I also have common stock of $10,000, and I have revenue of $10,000. But I have expenses, which are negative, of $4,900. And I have dividends, which is negative, of $500. So when I add them up, the liabilities plus everything in shareholders' equity equals $23,300. Okay. So you see, I have my balance sheet. I'm in balance. Any questions? All right. And let's now go to Blackboard. Everybody on Blackboard? Module 3. Analyzing transactions. Okay, who wants to? Oops. All right, fill in. Now keep in mind this must balance. So here, present below the 3 economic events. And each column indicates whether there's an event increase, decreased, or no effect. So the first one, purchase supplies on account. Okay, who wants to do this? Share your screen. Nora. Okay, share your screen.
We don't have Teams.
Okay, who does? You're not on Teams? Who's on Teams? Pardon?
It's not.
Doctor, there's no Teams on there's no Teams installed in the computer.
I don't understand. What are you talking about?
Doctor, Teams is not installed in the computer.
No Teams.
Oh.
All right. Let's go back then. Yeah, you have Teams on your iPad? Anybody have Teams? How come that's down? It's not down for me. Why is it down? Okay, Jay, can you share? Okay, help Yara finish this. Okay, good. Thank you. Activities. All right, first transaction. What effect did that have on the assets, the liabilities, and the equity? Right, assets increased. On account, no, wait a minute now, wait. I purchased on account. You understand what on account means? I purchased from a supplier. The supplier says, that's okay, you can take it today, but you're paying me at the end of the month. You have an account with me. Okay? So when I purchase on account, then I have an IOU, which we call accounts payable. What would decrease? What were the liabilities before I purchased it? Whatever they were, they're more now, right? Okay, good. Receive cash for performing a service. So I performed the service. If I didn't perform it, it would be a different account. So if I receive cash, right? Liabilities. What's the other account that was affected? You said it before. What's the other account? No, wait. I perform service. Every time I perform service or sell a product as a business, I earn revenue. Revenue increases shareholders' equity. So what we have here then, the what increase? No. Oh, no. Did liabilities, do I owe him anything? No. No effect on liabilities. So change that to no effect. Now, did shareholders' equity go up or down? Right. Increase. Does everybody understand that? Every time I earn revenue, shareholders' equity goes up. All right? Expenses paid in cash. So what happened to the assets? Up or down? Right. Did I pay off any liabilities? No, I didn't pay off any liabilities. Now, did my shareholders' equity go up or down? Down, right. Very good. Good. All right, number 2. During 2022, Concord Corporation entered the following transaction. Borrowed $59,600 by issuing bonds. Now, a bond is like a notes payable. Okay? Oh, they have bonds payable here. So, What effect, show me the effect this transaction has had on the balance sheet equation. The iPads are difficult. Okay, good. Right? Which two accounts? Cash and bonds payable, yeah. Cash go up or down? Ah, I received 5,600. You can copy and paste that. And bonds payable, did it go up or down? Or you have to put a plus or a minus in front. Okay, now go back to cash and put a plus there too. All right. Oh, you did put a plus. Okay, good. I'm sorry. Go down to the next transaction. Paid 9,120 dividend to shareholders. Which, you ask yourself, which two accounts? Cash and dividends. Now, what happened to cash? Up or down? Yeah, down. What happened to dividends? Now, keep in mind, dividends was negative. No, I think, yeah, make it negative, okay? Right, and dividends negative. Because that means when it goes down, retained earnings goes down, you put negative. All right, good. Number 3, received 19,002 from a previously billed customer for services performed. I already performed the services, so that's not the transaction. But when I performed the service, the customer didn't pay me. So he owes me. And when they owe me, what account do I call that? Accounts to be received, receivable. So now when they pay me, accounts receivable goes down. What else goes down? I'm sorry, what else goes up? Accounts receivable goes down. And what did I get? Cash. And cash went up. And both on the same side as the equal sign, I'm in balance. Okay, the next. Purchase supplies on account for 3,000. Purchase supplies on account, very good, accounts payable, and what did I get? Yes, you're getting it. See how they begin to repeat themselves? We keep practicing, we keep practicing. All right, good. Am I okay? Yes, very good, very good. Okay, again. Notice they're beginning to repeat themselves. Question 3, purchase equipment for 268,170.
Equipment will increase.
Yeah,
Given
right.
accounts payable.
No, did I say on it? No. I paid cash. Negative cash. Right. Equipment will increase. Now become accustomed to this because this is what we do. In journal, we record business transactions. All right. Issued common stock to investors for $36,140. Hey, wake up. You've done it? Hey? Okay. Help the class. All right. Issued common stock for $136,140 cash. Right, common stock. Okay. And purchased inventory for $63,580. Did it say on account? Yes. Purchased inventory, inventory is an asset, and accounts payable is a liability. Okay. Very good. Accounts payable.